today I'm going to start with a hydrogen car. Now, I know that doesn't relate to the economy per se, and it certainly doesn't relate to investments per se, but I think it's very interesting. I've been doing some research on it, and I'm going to share with you what I've learned. I think you'll find it interesting. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is August 15, 2023. As I was doing my research for this video, I came across something. It's in my blog feed from John Rubino, and he talked about the hydrogen car being the car of the future. Well, that caught my attention. I've heard about the hydrogen car a little bit. I know almost nothing about it. So I began to do research in it, watch videos, read some articles about it, and I think he's right. I think there is a potential for that to happen. Now, when you look over the last 100 years, or even go back further, go pre-automobile. So horses, horse and buggy, gasoline, diesel, electric, hybrid. So today, we have all of those, and then bicycle and motorcycle and so forth. We have all of these methods of transportation, all kinds of means of powering things. The internal combustion engines and gasoline is at the heart of it, but there are so many other areas that have started to come into play. It usually is not, at least I think today, is not this or that. It's some combination of all of these methods that seem to work themselves into the use of fuel and energy. And things aren't just related to transportation. They could be related to, of course, farm equipment and industrial equipment and all forms of the use of engines and fuel and energy. So I think, from what I've read, I think that the hydrogen car and the hydrogen methodology has a place in the future. There are pros and cons to it. Cost, availability, fueling stations, etc. On the concern side, and on the positive side, zero emissions, zero. And quiet, efficient, lots of positives. Toyota, among others, but Toyota has really taken the lead in this. They are now sold in Japan and in California, and I won't say it's on a trial basis, but it's more on early technology, experimental developing technology. But in California, there are 47 charging stations in various areas, which is not a lot. They are being sold there, and prices seem to be coming down in the fuel and seem to be coming down in the vehicles themselves. So I just thought it was really interesting, just on its application to vehicles, even though there are other applications as well. It shows me that the innovation and disruptive technology is alive and well. And when you think that, we can't go forever on fossil fuels, or, batteries with EV vehicles have huge kinds of environmental implications and so forth, you think, okay, and here along comes a new technology, and maybe it'll work out that way. I don't know, but I just thought it was interesting. So I thought I would show you just a clip from one video that just talks about it. It's a guy that reviews cars, and he's not necessarily advocating for it, but it's kind of a review. There's a lot online. If you just put hydrogen car in the YouTube or search engine, you'll find a lot of material, but I'll put a link to his video below. But anyway, I'll take a listen to this, and as something different, and maybe you're interested in it. I certainly was. It caught my attention. And some beautiful cars. Toyota, again, I think is at the forefront of this. So take a listen.
Hey guys, what's going on? It's Tommy with the Fastlane Car, and in this video we're going to answer a simple question. What is it like to live with a car powered by hydrogen? Because behind me is the brand new Toyota Mirai, and in 2021, believe it or not, you can go out and buy brand new a couple of cars that are powered not by gasoline, not by electricity, but by the most abundant element in the universe, hydrogen. So we're gonna see what it's like to drive, we're gonna see what it's like to fill up a car with hydrogen and get the full ownership experience. So let me introduce you to my ride for the day, the brand new Toyota Mirai. This thing is so cool. Now you probably have never seen one of these in the real world because of course hydrogen cars are currently only for sale in the state of California. But you can not only buy these cars, you can also lease them. Got keyless entry. And welcome to the interior. Now the interior in the Mirai is just as nice as the exterior. It may have a Toyota badge on it, but this thing is through and through Lexus. It really is that nice. What is it like to start up a hydrogen powered car? Well, my seatbelt on. Is it gonna sound like a flux capacitor? Key in the pocket, foot on the brake, push the start button. Couple beeps, couple bongs. That's it. Absolute pure silence. There's no whooshes, there's no crazy, I don't know, grinding noises or buzzing noises. It's just like starting up an electric car, because at the foundation, a hydrogen vehicle is an electric car. So let's go ahead and put it into drive. We do have a transmission selector that's very similar to what you'd find in a Prius. All right, so now that we're on the main road, how does a hydrogen vehicle work? What are the fundamentals? Well, it really is pretty simple in theory and very complicated in reality. So I am sitting on top of 3 tanks which store hydrogen at about 10,000 psi. Now that hydrogen is sent to something called the fuel cell, which is located underneath the hood, and the fuel cell is a very clever piece of technology that combines oxygen from the air with hydrogen from the tank to create water. Now in the process of creating water, it creates a little tiny zap of electricity, and if you have enough zaps of electricity, you've got propulsion through an electric motor. Very simple in its kind of thought process, but very complicated in reality, if that makes sense. Now, there's a little bit more to it. There's also a high voltage battery like you'd find on a hybrid car. It's about 1.24 kilowatt hours, so it is a small high voltage battery, considering like a Tesla is 100 kilowatt hours. But then again, it doesn't need a high voltage battery that's 100 kilowatt hours, because as you drive along, the fuel stack is making electricity to propel you down the road, and then the battery just kind of fills in the gaps. For example, under hard acceleration, you kind of have to build up that electricity production through the hydrogen fuel cell. So that's where the battery fills in the gap.
You know that I'm a fan of Mike Wilson, Morgan Stanley, and it wouldn't be complete without me playing something from Mike Wilson. He's very smart, he's very insightful, and he tends to be, even though he's on Wall Street with Morgan Stanley, he tends to be a very independent thinker and does not go along with the crowd that just says invest in stocks and bonds or they're always going to go up in general. He backs away from that and looks at things more independently. He does an interview here with Tom Keene and Lisa Abramowitz from Bloomberg. And in this, I appreciate him saying it. He kind of skips over it quickly, but he does say it, and I give him credit for that. He says, basically, Morgan Stanley, got it wrong for 2023. Or I think he uses the word underperformed, which means they basically got it wrong. They were too defensive and too cautious in a period when the market went up a lot, at least during the first 6 months. And but I would give him credit for this also, is that during 2022, they actually got it right. But he points out that many investment managers got it wrong. I would go on to say, and I'm talking about a lot of them, they not only got it wrong for 2023, becoming too cautious, they got it wrong for 2022. So they went into 2022 after 2021 thinking the market's going to go up and it may have a little dip, but it's going to go on back up. And what happened was the market, both the bond market and the stock market for 2022 went down pretty much the entire year and produced a very negative year for equities and for treasuries. 2023, with that having been set so clearly in the minds of so many people, me included, that 2023, most approached it with being very cautious. There's more downside. In fact, what happened was the market, the equity market, went up for the first 6 months quite a bit. There was a dip in February, but by and large, equities did very well during a period of time when Mike Wilson, Morgan Stanley, said things are basically going to be correcting and going on back down, and they did not, and he admits that. However, he is saying from this point forward, during the second half of the year, he's hanging on to his view, and I think Tom Keene is giving him credit for this, is that based on earnings or projected earnings and the valuation level, earnings being right now in the S&P 500 about 20 times, and that's a pretty high, 20 to 1, that's a very high price earnings multiple. And he says, basically, we've got a lot of risk in front of us. And that he says, basically, don't chase the Magnificent Seven, the, Apple, Google, Microsoft, etc. Those they've been termed, they've become a term now called the Magnificent Seven. He said, don't chase those. You're going to basically pay a price if you do, because those are the ones that have a lot of risk on them. In the last few weeks, we've begun to see, and I think this is at the point of his statement, is that we've begun to see a weakening in the tech sector, the Magnificent Seven, et cetera, and value stocks have started to come back in, or the value component of the indexes have started to come back into favor. And also, he makes a statement, or Lisa Abramowitz makes a statement, that bonds are not the answer either, because they have declined not only sharply in 2022, but they have continued a flat to negative position, kind of a decline continuing into 2023. And I think my takeaway on it is, if you're an investor and you're relying on information like this of, I think this, I think that, be cautious. And this has played into our hand very well because we're tactical, we're formula driven, and that worked out pretty well for us last year and has worked out very well for us this year. And so, and whatever's in front of us, I'm confident that using a tactical approach is much better than the traditional 60-40 buy and hold portfolios. Those have been creamed. They were creamed in 2022, and in 2023, they have been incredibly lackluster because of the bond component. But anyway, if you're in the traditional camp, and some are, take a listen to this, because I think Mike Wilson sheds a very good view, and he's being pressed by both Tom Keene and Lisa Abramowitz for his views. So take a listen.
Our conversation of the day now on the equity markets, the stock market, with Michael Wilson. Mike Wilson, CIO and Chief U.S. Equity Strategist at Morgan Stanley. Mike, you go over and you study Ellen Zentner's notes and you look at fiscal tightening. Describe fiscal tightening, describe what it means for the Standard & Poor's 500.
Yeah, good morning, guys. Look, I think, I don't think we've hit a wall completely here, but I think it's fair to say that the fiscal impulse that we've experienced over the last 12 months caught a lot of people off guard, including ourselves, and it has really kept the economy going in a way that most people were not projecting, and that has led people to believe that this can continue. Now, there's been a confluence of events for why interest rates have risen. I wouldn't blame it all on the downgrade last week. In fact, probably none of it is. I think the bigger issue is just simple supply and demand. We have an enormous amount of supply to fund all this spending, at a time when perhaps some of the natural buyers are not there anymore. For example, the banking system, pretty full up on treasuries. And of course, the Bank of Japan's changed last week. So, I think the interest rate move, look, first of all, stocks were already expensive on their own cost of capital going up. Now, think about it this way. The recovery we've had since COVID has been funded by the government for the most part, okay? And now their cost of capital is going up. So that has to have some sort of a knock-on effect to valuations. If we were trading at a lower valuation here, I wouldn't be so concerned about the growth outlook. But given our growth outlook, which is more pessimistic than most, that's where you have a real issue. And look, you can still make money picking stocks. It's just a harder game. And I think that's what most clients are having trouble with. We're not convinced yet. That the way we measure breadth is not convincing to us yet, but we're open-minded to it. But that would be the next stage of the bull market. If you want to be bullish, you have to be buying laggards here. You can't just keep chasing the Magnificent Seven and forget about everything else. That's not a healthy outcome.
What about what Cameron Dawson was talking about, especially at a time of rising yields, in part due to the fiscal backdrop, the supply and demand that you're talking about? It turns out that stocks become not a Tina trade, but a little bit. There is another alternative that's much better. The revenues are going up in an inflationary environment. Yes, multiples look high, but what are you going to do? Go into bonds that are losing value at this point? I mean, how much do you buy that type of argument?
Well, we don't buy it because our view is that inflation is coming down much more rapidly from, at the company level than it is in the government statistics. And this is where I think it could get really interesting or tricky in the second half of the year, which is we have government statistics reporting inflation still at 3 to 4%. So the Fed is, going to continue to hold or maybe even raise more. Yet what companies are actually seeing in their businesses, Lisa, are deterioration. Like we have negative price now in many of the good sectors, right? The PPI, finished goods, is in negative territory, export pricing, import pricing. So it's the opposite of 2021. Think of it this way. In the back half of 2021, companies were getting 15, 20% price, yet the Fed was on hold because they were saying, well, we're not sure yet this is going to be permanent. Of course, they were late to the party, and companies got to over-earn at a very low interest rate. Now you have the exact opposite. Interest rates are being held very, very high at a time when company earnings for the majority, not all, but the majority of companies is deteriorating. I mean, sales growth is not increasing. It's actually going down, and we have 0% sales growth in the second quarter. And if we're right on this pricing dynamic, then that's going to be something that catches folks off guard. That's why we're not going into small caps and the lower quality parts of the market. If you're going to go to the laggers, make sure you go to laggers that have good balance sheets and good margin structures. Okay, so it's still a quality play, just different quality names.
Now I'm going to shift gears again. So I go all the way from hydrogen cars over to Mike Wilson, and now I'm going into the labor market, which is and cover work from home. In the corporate world, work from home after the pandemic became commonplace. A lot of it almost required a lot of employees, if they could, began work from home. And what turned out to be very interesting, people became very productive. They were, for a variety of reasons. You got all kind of lifestyle issues, single parents, and just avoiding all of the stress and the time involved in commuting, which for some people is significant. And it became a paradigm that, and then they did a lot of studies on it showing that it was effective. So Alan Guerino from Korn Ferry talks about the pros and cons of that, and I think at the end he concludes or infers that some kind of a hybrid or some kind of a combination of in-office work as well as work from home is a paradigm that may emerge from here, and but it's right now in the process of evolving. So, and interesting thoughts from Alan Guerino.
To an office. Let's talk about it now. Alan Guerino, he is the vice chairman of, I don't know, how do you describe Korn Ferry? Jobs placement company, executive search, all things jobs.
All things jobs and all things talent. Talent solutions.
So they wrote it like a typical Wall Street economist. But the nugget out of that is that if you've got young children at home, right, and childcare is so expensive, or you're disabled, there's ways that remote work can benefit the workforce.
No question about it. And not only that, Brian, before the pandemic, if there's one silver lining with something as horrible as COVID, it is this remote work phenomenon. We were operating at 7,000 RPM in terms of the way people had to work. Starting with the introduction of the iPhone, email, text, work was 24/7. Life happened on the way to work and the way back from work. So I predict that it was going to break anyway. COVID sent everyone home, gave people permission to say, wait a second, I might not have to do it the old way. And now businesses are wrestling with what is the new way. By the way, people say, let's return to work. No, people have been working. The question is, where do I return to a workplace? Is it home? Is it an office?
It's evolving too. And I mean, anecdotally, I don't know where you live. I live in New Jersey. When I drive home tonight, I will get home quicker tonight than Tuesday, Wednesday, or Thursday.
Totally.
Because there's so many more people on the road Tuesday, Wednesday, Thursday. So I'm thinking, okay, a lot of people are getting, I think they're able to work from home Mondays and Fridays, but there's companies saying you got to be in the office. Is there a right mix, Alan? I know it's an impossible question.
Ask me in 5 years. I have companies right now that tell me, Alan, we went completely remote from completely in office. We have the highest engagement rates in the history of the company and the highest earnings we've had in years.
Yeah.
So the answer is, like everything, it depends. I think, to me, quite frankly, there's a benefit to the social component of being in 100%. An office, okay? But there's also a benefit to not being at 7,000 RPM and living and working 7 days a week.
Well, commuting takes years off your life. It's also, everyone's driving like an idiot, by the way. It's dangerous.
Absolutely.
Right? But there's also different types of workers. If you're young and hungry and want to advance, you should probably be in the office as much as possible, get to know your boss, whatever it is. If you're at the end of your career or just kind of know you're not going to advance, maybe you don't care, but there is an issue, and I know life ain't fair, but there is an issue of fairness. Is there not? And if you're going to advise companies, you say, listen, if somebody's not coming into the office, they're getting a de facto raise. They're not spending on commuting, gas, tires, clothes.
Sure,
how
possible.
How do you balance that out with companies?
But maybe they're working more hours, Brian, so maybe they didn't get a raise.
Right.
So, but here's the deal. You're the young worker, and by the way, they do want to be in the office. By the way, not 5 days a week. So there's a component of workers that want to be in office. There's a component of workers that want to be totally virtual. I call that the barbell. Let's say it's 20% on each side. The rest want what most people want, which is a hybrid model. So that kid, younger professional, goes to work. If the boss isn't there, what's that person getting? So the company has to architect a scheme where that young worker is in the office at a time when that supervisory employee can actually help them learn.
In this next clip, the people at CNBC talk about this, about during the most recent period, the last few weeks, technology stocks, which were hot during the first 6 months of this year, let's just say January through June, they have started to cool off. And they have started to come down in value, but boy, were they hot. And that was led particularly by AI stocks. And the hottest of those was probably Nvidia, certainly the most well-known. And the view is that be careful from here, because they are not only starting to come down, they are being viewed by those on Wall Street as weak from here. Granted, during this early period of this year, the first 6 months, there was a surge up, and they did very well. But what tends to happen is that tends to draw people in, the more unsophisticated investor, the investor that wants to get on board. I need to not be left behind. So I need to get my share of this growth spurt that's occurring, and it draws those people in. And if you look over the past several weeks, even the last month and a half, those stocks have started to come down, and those people who came in at the end, which tends to happen, then they got slammed. And so now they are suffering greater losses than the market itself. And that's just the way it works. And that frustrates people, because that's the paradigm for a lot of individual investors, unsophisticated investors who come in and who get caught by that. Not only is the tech sector, semiconductor component of that and AI component of that declining, but I would go on to say that fundamental analysis which leads people into this type of investing, again, hasn't worked. I believe in technical analysis, and I think that works better, at least it does for me. And but most of the world still believes in fundamental analysis of, I should buy this because of price earnings or because it's got future written on it or things like that. And it's a very rough ride and frequently disappointing.
Tim, what do you make of the action here in the chip space with Nvidia in particular? Does this actually give us an opening price point to jump in?
I don't think, first of all, until the 23rd, we know they're going to beat. The question is, how significantly are they going to beat? How great of a beat? And what do they need to do to actually put a floor under a stock that obviously was a rocket ship? And you can make an argument. It's easy to say now. That stock for 2.5 months after the earnings announcement last quarter was one that people were betting against and wrong. And ultimately, I think the AI dynamics in terms of the earnings potential of the company, we're going to continue to hear strength there. Carter talked about the charts. I think the dynamics in the semiconductors as a group more broadly are really fascinating because they've underperformed the S&P during that period where they're down 9%, as Carter pointed out, by almost 7%. So it's really been significant relative underperformance or not really making a relative high during that period from the Nvidia announcement on May 25th last quarter. So I think they're going to continue to trend lower too. We've also seen major rotation. Doesn't mean they fall out of bed, but I think there's still some room for this entire trade to go back. And note, obviously, the Qs have been underperforming as well, not as significantly, but they too broke through that 50-day. And I think the S&P follows. I think you take your cues from the market here. Does not mean devastation. It means that in August and September, where seasonals tell you that I think these markets could continue to be weaker, I don't think you have to chase any of this stuff into Nvidia earnings.
Julie, what do you make of what's going on here generally when we're talking about the chips? I mean, they have been so hot. It's been a sector that we paid such close attention to. But Bono brought it up earlier in the show. This week, there's been a lot of focus on energy, a top-performing sector here today. So is the chip trade cooling off? Are we moving back into the old economy here for opportunity?
It's really hard to say. I think that at the end of the day, for me, these are businesses that are cyclical, capital intensive, and they require really strong uptrends and secular trends that are very hard to predict. And I still continue to hear when I talk to management teams in the software business, when they're talking about AI, there is a certain reticence and a certain hesitation to really get aggressive about it. They all talk about it because they have to talk about it, but I actually don't get a sense that this, if you build it, they will come. That is not my sense. I think that, the concept of AI and generative AI in particular is going to take a much longer time to play out than people have in their earnings forecasts and models. I think Nvidia is a little bit different just because it has a near almost monopoly in terms of what it's able to produce. But I think for the rest of the sector, it's, for me, pretty unappealing at these levels. And generally speaking, not what I would say high quality.
So another point of view is Morgan Brennan from CNBC interviews Bob Elliott, and they talk about the same thing. So a different person saying kind of the same thing in his own words, but again, validating that be careful. Technology stocks are weak at this point and probably have more downside risk on them, and value stocks are looking better. And then, of course, bonds continue to decline, making 60-40 less and less of a compelling case at this point. Similar to what I just played is another brief video, it's about 1.5 minutes, where Morgan Brennan from CNBC is interviewing Bob Elliott, and he's making the case for the same thing, that technology stocks, the NASDAQ 100, is showing the highest level of weakness at this point as we're going into these normally somewhat negative months of August and September. And so it's just another person from a different perspective saying the same thing. And then the comment is made, and bonds are falling too. So that bonds are not the place to go now as a safe haven against equities, and particularly against technology equities. When I look at the decline of the NASDAQ, the decline of bonds, and the risk that's in the market right now, it reminds me a lot of 2022. This is a short period of time. I'm not saying it's going to go for 12 months because I don't know, but a lot of this played out most of 2022. So take a listen.
Stocks closing out an up and down week with a mixed session, as I just mentioned, led by the blue chips. The Dow managing to hold on to gains for the week and the day as well, while the NASDAQ composite fell 2% on the week. Joining us now is Unlimited CEO Bob Elliott. Bob, great to have you here on set.
Nice to be here.
I want to get your thoughts on what we've seen in the markets. We've been having a lot of discussions in recent days about the fact that this is a market that was due for a pullback. How do you see it?
Well, we started to see a little bit of the markets starting to create that tightening. Rather, the Fed has kind of backed off a little bit and said basically they're done for now. And then we've gotten enough move on the long end to start to create some financial market tightening. And so what you're starting to get is those high flyers are feeling the effects of that market-based tightening and are starting to come down. That's why what we're seeing is the tech stocks underperforming, and we're actually seeing energy stocks outperforming, stocks that had lagged for much of the year.
Is that a trade that's sustainable here?
Well, I think so, because what we're seeing is the strength of the economy is continuing to flow through. You're seeing those commodity prices continue to rise, right? A great example is, this week, commodity prices, oil prices up 7%, as you noted, and that's really supporting those stocks. At the same time, you're getting tech stocks, we're talking about PEs at 40, right, for the tech sector, for the XLK ETF. How does that look in an environment where we're starting to actually get that tightening of monetary conditions, that long end rising? It's going to be tough to maintain that high flying in that sort of environment.
Okay, thank you for listening. I gave you several different topics, basically 3 different general areas, not related to each other. Hopefully that was helpful. And the Fed is out sucking money out of the system, selling treasuries and mortgage-backed securities, vacuuming money out of the system. This is not good. This is not a good picture. So going forward, I don't know how that's going to play out. But right now, it's not helping the picture that we need to return to a growth economy. Thank you for watching. If you have questions or comments, leave them in the comment section below.